Good afternoon. This is Kelly Buckley of Spectrum Financial Alliance. Running a little bit behind today. We've had some technical difficulties. It's September 23rd, 2020, and today's Facebook Live is going to discuss some things that are very important to your portfolio. Things like the Supreme Court appointment, COVID-19, and the election's effects on the portfolio, particularly in the upcoming quarter. Hard to believe, but we're almost done with the first 3 quarters of the year. So let's talk a little bit about economic trends. Goldman Sachs just raised their third quarter gross domestic product growth forecast from 30% to 35%. Consumer spending really drove that, folks. The consumer's wallet opened up considerably by the end of the second quarter. That's a good sign. Shows that consumers are confident in their income and in their ability to purchase assets. This 35% growth forecast is historically high, and it compares to the average economist consensus of 21%. Why do I mention it? I mention it because we believe that 35% is close to where it will actually end up in the fourth quarter. You're seeing now a graph of gross domestic product growth, and this is going back several quarters into 2017. You see the growth of our economy here when you look at GDP. Gross domestic product is a sum total of all goods and services produced by our economy. You can see where we fell off the cliff after February of 2020. And we wrote about this extensively in March and April and beyond of this year. We talked about a V-shaped recovery. Now you can see the V. The precipitous fall will be followed by a very steady and equally precipitous incline. This graph shows you GDP quarter by quarter, and you can see the ruinous quarter we had in the second quarter of 2020, where we fell about 32%. We've shown the estimate that we believe is correct for the third quarter of 35%, which will largely offset the first 2 quarters' declines. The Consumer Price Index is important as an economic data point because it shows that consumers are willing to pay for goods and services. And as you will note in the graph, we also fell off a cliff there as consumers closed their wallets and their purses in February, March, April, and beyond. But with the economy's reopening in June, we now see the consumer prices are upticking again, indicating steady demand for consumer goods and a willingness to purchase by consumers. Consumer Sentiment Index is a forward-looking vehicle. If you note on this chart in February of 2020, it topped out at 101. That's a very high Consumer Sentiment Index reading. Then beginning in March and April, fell significantly, rose a little in May of 2020, and then rose a lot in June, followed by some reclosings in July, and then we've grown steadily through September, where we ended at 78.9. We believe the Consumer Sentiment Index is likely to continue to grow at a steady pace through the rest of this year and may get close to 100 by the end of the calendar year. Labor force participation, we're going back here to about 2012. You'll note that the labor force participation rate, which is really important because what it indicates is that people are willing to get up, get a job, and participate in our nation's economy. That rate had fallen precipitously from 2010 through 2016's end and began to rise with the initial election of the new administration, President Trump's administration. Fell off a cliff when everybody was laid off and told to stay home in February of 2020, March of 2020, and is rapidly growing back in the same V format we see with GDP. Unemployment rates have fallen significantly in the last 4 years. In fact, we've had historically low unemployment until the pandemic, and then we see a spiking to high recessionary levels with a inverted V, indicating that the V-shaped growth on GDP, consumer sentiment, CPI, we're seeing the same data point here with an inverted V on unemployment rates. Minority unemployment was at record lows, all-time historical lows. And you see that represented here with the August 2019 data point for Black and Asian unemployment. Those rates, like everyone's, went up precipitously in the months that followed. Unemployment rate for women was also at a historic low in February of 2020. You see the incline caused by the pandemic, and you see the track we're on to get back to those historic lows. This is a really interesting chart, and it's a little busy. The red line is unemployment rates based on the March to August 2020 time period. The blue line shows March to June recessionary data and beyond, the number of months intervening. And then we see the recession of 80 to 82, and we see the recession of 2000 to 2002. The bottom line is, in this recovery, we've been on the steadiest march to extremely low unemployment rates, record low unemployment rates. We had an intervening COVID event, but this is showing superb progress in a very short period of time. We're likely to see that progress continue through the rest of this year and beyond. Factory jobs created from 2013 to 2020. In 2013, there were 146,000 and some change factory jobs created. You can see the steady rise in factory jobs, particularly the increase between the election of our current administration and now. That increase was stifled again by the pandemic, but is very likely to show great progress through the end of the year. Real median household income in 2017, 18, and 19 showed remarkable increases. That trend is likely to continue. Hourly earnings, going back, we look at the last administration from 2008 through 16, declined to stagnant at all employee levels, with increases, significant increases, occurring in hourly earnings from January of 2017 on. Even the spike down caused by COVID that you see in 2020 has now been arrested and is likely, in our opinion, to result in another V-shaped recovery. Hate breaking these things out by race, but they seem to be important in our society today, so we'll show it. Great progress by minority workers in percentage increases from the last Tax Reform Act passed into law in January of 2018 and against other groups, white, etc. Black unemployment rate reached historic lows prior to the pandemic, but is still higher than the rate of white unemployment. Thing I think that's interesting here in this chart is notice that the gap is closing, and notice when the policy shift in January of 2017 began to accelerate that close. We're going to talk a little bit about COVID-19 now and give you a bit of an update there. This is a very simple chart that we put together. The data is good as of 9/22, and actually for Europe, these are 9/23 numbers. Total cases in the U.S. equated to a death rate of 0.06%. In Kentucky, our death rate is 0.02%. And in Europe, they're running the same thing we are here. This is Europe, including the UK, England, and they're at 0.06% as well. Go back on that slide, please. I think the important thing to emphasize here is there's been some concern that maybe we're lagging other parts of the world. We're not. The death rate is clear. It's an immutable statistic. You can't play with that one. Next slide. Why is the Supreme Court important for the election and for our national security? This is an important topic, folks. It's been all over the press here since Justice Ginsburg's death. Supreme Court case comes up on November 10th, and this is a challenge by several states' attorney generals to the constitutionality of Obamacare. They're going to start hearing oral arguments on November 10th. A decision is expected in that on June of 2021. But we also know that the 2020 election is extremely likely to go to the Supreme Court, just as it did back in 2000 with the Bush-Gore fiasco. And you all may remember that was the hanging Chad debate. We didn't know who our president was going to be for 6 weeks after the election then. This one could easily be worse because mail-in ballots are incredibly easy to commit a lot of fraud, and we're going to see a lot of challenges to those votes, both by Republicans and Democrats. The 6-week ordeal that we had in 2000 is likely to be replicated, and that one was solved by the Supreme Court. That's where this case is likely to go. Now, if the Supreme Court only has 8 justices on it when it gets there, we could easily see a tie at the Supreme Court. That would create a huge constitutional crisis that this country does not need and should not want. Our president is authorized upon any vacancy and actually required by the Constitution to name a replacement. The United States Senate is required to advise and consent to that appointment. And those things will occur, we believe, prior to the election. So we have a full Supreme Court of 9. Next. You're there. What should you expect in your portfolio returns in the fourth quarter and beyond? During the fourth quarter, folks, we think we're going to have the best quarter we've had in many, many years. Your average return should be approximately 20 to 30%, and we're being conservative. Remember that on April 2nd of this year, we called the market low as of March 23rd, and that has easily held. March 23rd was the market low. Your returns net of costs are in the high 40s, 40% range, 48, 49% as of today. The S&P 500 return during that same fourth quarter we think is likely to run about 10% less than our portfolio expectation of 20 to 30%. And more importantly, when we look longer term, we're expecting the market, the S&P 500, to annualize approximately a 15% return over the next 4 calendar years. Why? It's because of precipitating events that are going to cause the economy to advance at a much faster than expected rate. Here are some drivers of that. Sustainably low interest rates. The Federal Reserve announced about 2 weeks ago that they're committed with short-term rates, which they unilaterally control, the Fed funds and the discount rate, to maintain rates at almost a 0% level. That's going to give a lot of capital availability to a lot of businesses who are hiring, expanding, etc. Most of the time, the Fed couldn't make that assertion because it would lead to high inflation rates that we could ill afford. But the Federal Reserve has a lot of flexibility in this economy and actually now is targeting inflation at or above their normal target rate of 2%. The impact of those policies on your banks is high because banks borrow based on short-term rates. Go back, please. based on short-term rates and they lend based on long-term rates. What that means is that banks make more money when rates are higher than low-term rates that they borrow from you and me at and pay a money market rate or a passbook savings rate on. This moderately higher interest rate movement we'll see for long-term and intermediate term rates will also cause bond investors losses. Those bond investors will sell their bonds and they will buy what I believe we're holding in your portfolio right now. Potential further stimulus is also another precipitating factor in the movement of your portfolio. Prior to the election, we believe it's likely that the House and Senate will advance a further stimulus plan to provide more economic support to the American people. This could include additional individual $1,200 checks, but we think it's likely to include help to some of the industries we've targeted in our portfolio. That would be transportation with Delta, hospitality with Marriott and Royal Caribbean, etc. China fallout hasn't begun to happen yet. Once we're done with the pandemic, this is going to be lawsuit heaven for plaintiffs' attorneys. The flight of jobs and factories from China is going to be huge. And they're going to come to the U.S. or to somewhere in the Western world. China will end up paying a heavy economic price, a diplomatic price, a legal price, and a settlement price for their documented misleading statements that resulted in widespread transmission of COVID-19 and millions of deaths. The rush to the exits from the COVID pandemic that I've written about and that we've talked about here has only just begun. I'm sure that as you talk to your friends and your associates, you're getting a lot of the same feedback that we're getting. It doesn't make much sense that we can play sports but our kids can't sit in a classroom. It doesn't make much sense that teachers' unions say they don't have the money to clean their classrooms when Kroger is paying someone $15 an hour and asking them to clean. These things are debilitating to our future generations and they're intolerable to our society. CDC statistics show clearly that children age 18 and under have a mortality rate due to COVID of 0.01%. Every life is precious, but we have to make sure that the medicine we're using to take care of the pandemic does not destroy more lives and kill more people than it saves. Trade agreement with the EU and their policies. These are also things that we need to take into account when we think about the economic path forward. Additional trade agreements are going to come on the heels of USMCA, that was the Mexico-Canada-US agreement, and the China Phase 1 deal. The European Union is likely to come to the table very rapidly in a second Trump term. We're already working on a separate trade agreement with Britain because once they separate from the EU, which should occur this year, there's going to be a huge windfall in trade with Britain for the United States. Our border control policies are going to make a big difference going forward. They lead to higher protection for American jobs, more emphasis on the incomes of American workers, and higher real wages, especially for lower skilled Americans. And then we have, for the first time in my lifetime, a real peace dividend. We're going to end the Middle East adventurism. Going over and making sure we took care of the Taliban in 2001, that was a great policy. But we should have exited. Going into Iraq, in my opinion, was a good policy. We had every reason to believe, and every intelligence agency in the world stated that Iraq had continued their development of WMD, weapons of mass destruction, nuclear, chemical and biological. But staying there was a huge mistake. Ending those wars, bringing our troops home, which President Trump has done and continues to do, will end the huge costs, especially in the lives of our children, that have gone on now for almost 20 years. The Israel, Bahrain, UAE, and Bosnia-Serbia peace agreements negotiated by this administration, our current administration, by President Trump, are groundbreaking in a historical sense. It has taken us 20 years to get to this point, and you're going to see another rush to the exits by other Arab countries like Oman, and I think eventually Saudi Arabia, who will also sign separate peace agreements with Israel, which will force the Palestinians to sign their own agreement and end terrorism that has cost hundreds of thousands of lives for 20 years. The end of expeditionary wars due to the success of the current administration's policies was allowed because we virtually annihilated and eliminated both ISIS and Al-Qaeda. This is a consequence, folks, of energy independence. If you're energy independent, which we totally are, we have more oil and gas in the ground than any country on earth. If you're totally energy independent, you don't need to rely on the Straits of Hormuz. You don't need to rely on the Saudis or Kuwait to bring you oil. And that means we don't need to have American troops based in the Mideast where their lives are at risk every minute of every day. We're also reducing basing in Europe. In my opinion, as a former NATO instructor pilot, that should have happened a long time ago. We carried NATO's water for a long, long time. We bore the majority of the responsibility for the safety and defense of Europe, and that resulted in extraordinary costs. And in the past, some of our leaders, both in Congress and our presidents, have attempted to impress our friends, the Europeans, by carrying that water. But that was at the cost of American jobs, the cost of American taxpayers' reduction in the quality of their lives, because we paid for it. Those days are ending, and now, after America made clear that NATO had to pick up the slack, they have picked up the slack, and they're spending hundreds of billions of dollars more in the out years for their own defense, which will preserve NATO, make NATO stronger, and allow Americans to come home. Reducing basing in Europe is needed, and this is a real peace dividend. The U.S. House and Senate were asked about regularly in terms of the election. On a Facebook Live in July, we said based on the Electoral College count, we think that President Trump will have a second term. It looks clearer now based on the Electoral College count. But the enthusiasm gap is huge, and it makes a lot of difference. The enthusiasm gap between our presidential candidates is much larger now than it was in the 2016 election. That means that those folks who are most enthusiastic are most motivated to go to the polls and get their vote in via mail or other means for this election. The Senate, we believe, will be held by conservatives. That's important. We've had historic levels of success in getting constitutionalists in our federal appeals courts, federal courts, and on the Supreme Court in the last 3.5 years. That ability to maintain constitutional government is important to our children and our futures. We do not think the Senate will switch hands. We do not think that the margin will narrow more than 1 or 2 votes. So Senator McConnell will continue to be the leader of the Senate. The House at this time, we believe, is a toss-up. We think it's possible that there will be a change in power there, and the conservatives will take the House over. So where's your confidence? You know, I've had the privilege of working for you and a whole lot of really good people for over 3 decades. And I've never been so confident in our economic and investment projections. Doesn't mean I'm right. I've been wrong before. But this time it looks very clear what the outcome is. Political outcome looks clear. The continuance of President Trump's policies, which have brought our economy to the greatest heights in the history of our country as of the end of February of this year. Those policies are going to be reelected in all likelihood, and our firm's projections for returns we are extremely confident in. Our firm has performed the S&P 500 year to date, and a big reason for that is we've held our banks. Our banks were extremely undervalued on January 1st, and now they're ludicrously undervalued as of today. But the banking sector is specifically a target for us because of the Fed's guarantee of very low short-term rates and inducing greater inflation, creating more of a spread between long-term and short-term rates, which will increase bank profitability. Banks will also benefit from a continuation of the Trump policies in a second term. So we think that's where extremely large upside movements are likely to occur in the near future. It's important to understand, folks, that our firm only sells assets in your accounts when we believe we're on a recessionary path. That's what we did in September of 2008 when we went to about 75% cash. We don't sell in what we define as glitch events. A glitch event, a good example of that is COVID. When COVID started, we did not believe we would have a recession. Now technically, we're in one because we've had 2 consecutive quarters of negative gross domestic product growth. However, we still classify it internally as a glitch event because it's extremely short-term in nature. It's not related to anything fundamentally with our nation's economy. And for that reason, we did not sell. We have accumulated recently. I'm going to talk about that in just a minute. We don't sell in glitch events because doing so long-term costs you a lot of money, and it costs you the gains you would easily win back in a fundamentally good economy. An example of that would be the fourth quarter of 2018. On December 24th of 2018, we sent you a letter. We called the fourth quarter event a glitch event, and we called December 24th as the likely low for what we said was a market cycle. And that was correct. It was the low for that day and for the market, for a market cycle. And since that time, we've had an incredible amount of growth. Now that meant we had to accept a 10% decline in 2018 that spooked some folks, but that's what set up our 2019 return, which was exceptionally high, little over 38% net of cost, and 10% more than the S&P 500. So if you sell during a glitch event, you're going to incur some cost, primarily in taxes, because we're selling things we've held that have embedded capital gains. And then you've got to make a perfect second decision, which is when to re-engage the market. That's why we don't do that. We avoid the taxes caused by the selling event. We keep your capital working. We accumulate where we can, or become a little bit more aggressive, allow the glitch event to work itself out, and then greater gains occur long term. This is the reason that I believe our firm's returns, according to Dalbar studies, are approximately twice the average investment advisors. So we're not trading, we're investing, and investing works out consistently long term. Over the last week, I should mention, we've done a lot of portfolio positioning. And I've done that, folks, because I'm trying to prepare for what happens in a few days. And that is, believe it or not, the last quarter of 2020. And all I can say to 2020 is good riddance. It's good to see it come to an end. But in preparing for that, I've got to be real. I've got to be realistic about expectations. My expectations for the fourth quarter's performance economically and in our investment portfolios, as I stated earlier, is huge. So we've biased our portfolios more towards this economic reawakening, towards the economy reopening. And we did that by increasing holdings on things like Marriott, but also added some that were more negatively impacted by the economy's closing, like Royal Caribbean. Another holding that we just recently added was General Electric, and I did have a question on that I'll get to in just a moment. We believe so strongly in the economy reopening, so strongly in your investment returns being way above average, that we've added to our portfolios and even margined to a small extent. We believe the fourth quarter GDP number will be historic. We think your investment returns are likely to be huge. And we think when we look back on 2020 and we're looking at gross domestic product for the year, in a year where GDP plunged in the second and third quarter by over 37%, we think it'll be positive, and we think it's likely to be 3% or higher. That's how good the fourth quarter is truly likely to be. That 3% number is a magic number because it doesn't happen very much and hasn't happened for almost 20 years. So now let's get to questions. And first question I had today from a wonderful lady I've had the privilege of working with for a long time. And she asked why we just bought GE. And she also said, I don't want to know my balance, so we will not tell you. But GE was a purchase that was made after years and years of GE consolidation and decline. GE's gone through several CEOs in the last 10 years, and none of them quite measured up to their previous CEO. GE was a large conglomerate that over that time has had to consolidate businesses through sales to return to profitability. And they're not there yet. However, I think they're on the cusp. It is my belief, based on GE's second quarter earnings report, that they will see a profitable third and fourth quarter, both, of this year. And for that reason, we wanted to start to acquire a position there. And we're not done building our GE position, but I expect GE to be exceptionally profitable. The upside on GE over the next year is likely to be 80% or higher. Remember, GE has a large aerospace component. They make a great jet engine. They do some other things in the defense sector as well. But those engines, of course, have suffered greatly because commercial aviation has become very stagnant, and that's led to issues with things like Boeing that are very, very short-term in nature. So based on the turn in the economy, based on the work done under a great new CEO at General Electric, we elected to begin nibbling and taking a position in GE. We believe that GE's consolidation is done. They'll be back on an expansive path going forward. We also believe that GE's profitability will be positive in the second quarter and beyond in the years to come. So a large mover there and what's likely to be a good addition for us. And with that, Brittany, do we have any other questions on Facebook Live? All right. I just want to say thank you for tuning in with us. If you do have any questions that you want to ask individually, either email us, text me, or call the office, at 859-223-6333, 859-223-6333, and we'll be glad to address it personally now. It's a privilege to have your time and to have the opportunity to help your family and you build your financial security. Thank you for that opportunity, and have a great day.